All right, my man, Corey Ashton Walters. I'm excited to dive in with you more, man. Let's just kick it off with what the impetus was for starting here.co. I'd love to learn kind of where you were in maybe your last startup and then what you saw in the market or however you saw the opportunities to start here.
Yeah, great to meet Mike. Thanks for having me on. Wow, what led us here, so to speak. So this wasn't my first startup. So before here, I co-founded a company back in 2017 called Homeworthy. I was living in New York City at the time. I had a co-founder, and we had a hunch. So we felt like people living in small town America were underserved in the tools and technology at their disposal to sell a house. So this is still true to this day. You know, you look at a random real estate listing in rural America and like looks like the average agent takes photos with like a crappy cell phone or an old digital camera. They slap a yard sign in the yard, they list it for sale and, you know, give me a 6% commission, please. That's generally the rundown. So we thought, well, what if we brought big city tools and technology like, you know, drone aerials, 3D scans, video walkthroughs, you know, things you'd see in, you know, a real estate listing in, you know, New York or Los Angeles or Miami to small town America? Could we sell their homes faster and for more money than their neighbors? So we launched with that thesis back in 2019 in the Pacific Northwest. We chose Vancouver, Washington, and Battleground, Washington as our first two markets. And over the course of about 10 months, we grew to about 900 small towns and cities across the entire Pacific Northwest. So if you lived anywhere in the state of Washington or Oregon, we could help you sell, you know, a home and for the fraction of a cost of a traditional agent. You know, fast forward a little over a year and we hit March 2020. Like most people, you know, world gets turned upside down. My world gets turned upside down. Everybody's world gets turned upside down. But in Homeworthy's case, it was kind of our moment. You know, we built a fully remote way to sell a house during a time that, frankly, nobody wanted to meet anybody in person. And we found a really interesting opportunity there of, Seattle was basically patient zero for COVID. And we were like 2 hours from Seattle. So we got all this great press coverage and, you know, Homeworthy had its moment and we had this massive growth curve, about 300% month over month. The challenge with great growth came, you know, great burn. So I think we were going into that month, we had about 100 days of runway, and coming out of that month, we were projecting to have less than 30. So we had to move pretty quickly. And the third week of March, we tried to raise money from our existing investors to keep throwing coals in the fire. It's like, we're growing. This is the best time for this company at this point. You know, we've been growing and this is really the best time from a traction standpoint. The challenge was, it was like the third week of March, the stock market was upside down, and most of our investors were living in states with threats of shutdowns, which had never happened before. So everybody was like, no checks, like make it to the summer. There's no checks coming across the bow. And, you know, after about a week of not being able to clear market with our existing investors and every other investor we talked to basically ghosting us, I make the tough decision to lay off our entire team of 12 at the time and, wind down the company to a slow burn as possible. So the idea was like, well, if we lay everybody off and try and make it through the summer, maybe we can, you know, everybody thought COVID was going to be over by the summer. Like maybe we can kickstart the company back off if we could if we could just survive. And, we make it to June. I moved my family down to Florida, which is where I am now. And we just try to survive. And, around June, we tried to raise a bit more money from our existing investors, kick the lights back on, try and restart things. And we just couldn't clear market. You know, my team was unemployed. They're happily unemployed. We didn't have any traction. We just didn't have the magic that we had when we were growing. And just couldn't find product market fit with investors. So, you know.
How are you feeling at that point?
10 out of 10 depressed. Actually, I would say probably 8 out of 10 depressed. 10 would be suicidal. I'd say 8 out of 10. At the time, I was also going through divorce. So it was, 6 months before, company's doing great, happily married, living in the place that I want to live. Everything's going great. To fast forward 6 months forward, going through the divorce, company's done, marriage is done. You're living in, Florida, which is where you grew up. It was a huge ego trip for sure. So about, 8 out of 10 on depression. Very tough.
How did you get through that? Anything that you grasped onto?
What's interesting is that after the first couple conversations we had with our existing investors, I was expecting FUs, people yelling, threats of lawsuits, you name it. And the first investor I called said, well, what's next? What's the next project? It's very interesting because I've never started a company like that before where you're allowed to fail and your investors are like, okay, well, let's do something else. And it really gave me a bunch of confidence in a time where I had none. I was like sleeping on the couch, everybody's been there, like as depressed as it gets. So I just picked up books, articles, whatever I could read, just like looking for answers, looking for inspiration, looking for what to build next. And around this point, I think Airbnb was getting ready to go public. And there was a really interesting research report from a company called Grandview Research. And about halfway through the report, there's this metric that I'll remember for the rest of my life because it sent me down a rabbit hole that I'm still going down, which is by 2025, 75% of all travel and leisure spend in North America is going to be made by millennials or younger. And that was a big light bulb moment, and also, determination. Basically means over the next half decade, next 5 years, the majority of spend on flights, hotels, travel-related activities, accommodations, et cetera, is going to be driven by millennials and younger generations. Why
was that so shocking to you?
Well, I didn't realize it was coming that fast. Millennials are now getting pretty old. I mean, some of us are almost 40. So it's like, I didn't realize it was coming that fast. I knew that meant there was a wave. So like, there's a wave here. There's like a wave buried in here somewhere. And I, went down the rabbit hole, popped out the other side and was like, okay, there's gonna be a pretty big, supply demand imbalance of like the demand for alternative accommodations. There's no secret that when millennials travel, they prefer, glamping, short-term vacation rentals, cabins, yurts, et cetera, when they travel. And the current supply that exists, there's a pretty big imbalance there. I don't know the last time you stayed in an Airbnb, but it's pretty unpredictable when you open the door what you're going to walk into. Is there going to be dirty plates in the sink? Is somebody still going to be living in the property? Are the sheets going to be dirty? So largely it's a fragmented industry of like independent owner operators or independently owned with a third party manager. So we thought, okay, there's probably an opportunity here or a wave that we could ride. And I think the original idea for here was we were going to build roof stock for vacation rentals.
What is roof stock? No.
So what roof stock does is they acquire single family homes, they fix them up, they fill them with a tenant, they sell them to one end investor, and then they manage it for that investor. So the idea is like a turnkey real estate investment. Where they, find the property, fix it up, fill it with a tenant, manage it for you, and then you just collect a check. So we thought we could build a similar portfolio of properties, consolidate, in that space of short-term vacation rentals with this roof stock style model. Mm-hmm. But that didn't work. So after about 2 weeks, we were like, there's no way to get loans on these things. I mean, I got doors slammed on me one by one. It's almost easier to get loan. I would say it is easier to get loans on farmland than it is vacation rentals. The main
why
reason,
is that? Yeah.
Well, the main reason why is most loan programs that cater, most loan programs that apply for short-term vacation rentals are repackaged long-term loans. So they want to underwrite the property like a single family property that has a single tenant in place for X amount of months or X amount of years. So when you're filling out the application, they go, well, how long has the tenant been there? The answer is 0 or days. And they underwrite it like a long-term rental. So there's challenges there because most of these vacation rentals don't actually cash flow as a long-term rental, which then means you don't pass underwriting, which then means you don't actually get the loan.
And this is you're speaking as the person who would purchase the property and then use it out to do Airbnb?
Yes. Yeah. And you got to understand with this idea or this original idea of like this roof stock model was, okay, we have to sell it to somebody that has to apply for this loan. So if we can't get a loan and we're doing it professionally, what's it going to be like for, Jane, the product manager at Google, or Joe, the lawyer, to get a loan? The answer is they're going to have to buy it in cash. And most of these homes are $400,000, $500,000, $600,000. And who has that much laying around in cash? So we thought, this is too small of a market. It's going to be basically super wealthy people that you're going to be able to sell these to, because there aren't going to be any mortgages available for them. So
now, why wouldn't I would imagine if I'm a bank and I'm issuing mortgages out there, I would just adapt the model. There's an evolution in the market. People are buying properties and then renting them for shorter time periods. It doesn't even seem that innovative. It's just, okay, instead of like 3 months or longer or years or longer, it's now days or weeks. Is there some structural blocker?
Yeah. I mean, if you're a bank, you gotta think it's a pretty risky asset class, depending on where you live. I think you live in Portland, vacation rentals are highly regulated, and regulation comes and goes on a daily basis. So let's say you write a mortgage for a home that's a vacation rental, and then 6 months later, it's banned. Well, now you've got a mortgage that doesn't cash flow. They're losing money every month. You have a high default rate. So it's very hard for them to underwrite. And then also it's a very new industry, and what I mean by new industry is that, growing up, my, family had timeshares. It was a thing. Vacation rentals were still a thing back then, but the whole idea of an Airbnb and that becoming its own segment is very new. And again, this company just went public a little over a year ago. So I will say, like, the mortgage industry is catching up, and they're trying to apply old methods to a new age way of optimizing real estate through, a short-term vacation rental. So, hit that wall, didn't give up, but after a couple weeks of toiling, I got hit with an ad for a company called Masterworks. Are you familiar with Masterworks?
No.
They do fractional ownership of artwork. So the idea is that, like, you could own 1% of a Basquiat or a Banksy or, some really awesome artwork that's worth a lot of money that appreciates well over, a decent time horizon that's somewhat stabilized, that was normally reserved for super high net worth people, to own all of it. Generally, if you want to buy artwork, specifically high-end artwork or collectible, you've got to buy all of it. And what's interesting is Masterworks uses this regulatory instrument called the Reg A Plus. And the Reg A Plus is this SEC framework that allows you to fractionalize anything of value. It could be a piece of artwork. It could be this coffee cup if it were rare. It could be anything. That was a big, I'd say, the second light bulb moment in Here's History, because I realized I could actually apply a fractional approach through a Reg A Plus instrument that, like, a company like Masterworks uses to an asset class that has a ton of barriers to entry. One of them being the financial structure of, incredibly hard to get loans, very expensive, very hard to manage, et cetera. And then instead of having to sell it to one end investor, we could then have, hundreds of investors that own, shares and take part in those financial benefits of being a partner on a property that produces cash flow.
That's exciting. And that's the Reg A Plus is applicable to anything? I mean, is there a limitation on anything that somebody can own? I'd imagine there's carve-outs for real estate, given that it's like when you buy a house, you don't pay sales tax just because of the carve-out, right? So are there in place now any either good or bad laws specifically for real estate?
It's an interesting question. I'm not aware of any specific carve-outs for Reg A Plus on, like, prohibited asset classes. Maybe there's stuff around gambling or, general vices, but, there's a company called Otis that does fractional ownership of collectibles and rare items. There's Rally Road, which is collectible cars, fractional ownership there. So it's really a wide berth of different assets. And I would say within the last year, real estate's really come online. And crowdfunding in real estate isn't a new thing. It's been around for probably the last 10 years. The benefit of the Reg A Plus, though, is that most crowdfunding platforms like Fundrise, et cetera, you're kind of like funding like a debt vehicle as an investor. You're not really an investor on the property. You're kind of funding this weird instrument. The way the SEC sees it is that you're basically the owner of you're the owner of an LLC. So the property does one thing. It buys an LLC, or the LLC buys a property. And then you have X amount of partners on that LLC. Just like if you and me this weekend went out in Portland, partnered on a property, you own 50% and I own 50%, you'd be entitled to 50% of the appreciation, the cash flow the property generates, the depreciation and tax benefits, things of that nature. But the difference is, well, instead of two of us owning partnership with that LLC, we use the Reg A Plus to break it up into hundreds of investors.
Right.
5, 6, 700 investors that have the same ownership rights, but instead of needing to have 50% of the cash, you could have 1% or less than 1% of the cash to still have ownership stake and ownership rights of that property. So I would say the Reg A Plus powers that. Yes, sorry.
Yeah. Well, I'm wondering, do you know what the blocker was previously? So I'd imagine when you start an LLC, you can have 2 members, 3 members, 4 members. Was
Certainly.
there a cap on it almost seems like that would have been possible before. Was there something in place that prevented a fairly infinite number of investors on a LLC?
I think the big thing that's prohibitive there is solicitation of securities. There's nothing stopping. Again, it's like if you and me had 40 friends and none of us were accredited investors, nothing stopping us from 40 of us being partners in a property. The big unlock is the solicitation of securities to unaccredited investors that allows mass fractionalization. And that's somewhat new. I'd say within the last 5 or 6 years, the Reg A Plus has really come online. It's been one of the big powerhouses in fractionalization for assets.
Yeah, hence the crowdfunding platforms that have been WeFunder and maybe AngelList. There's a bunch that have popped up.
Right. Yeah. Yeah. Certainly.
Interesting. Okay. So then you say, let's do this for rental properties. You see the need in the market, the inability for mortgage companies, lenders to adapt. And then Reg A Plus allows you to advertise investment opportunities. And you say, why not build a platform where people can invest in short-term rentals? And then you walk me through what that looks like in practice, and if I described it correctly.
Yeah, I would say that's the thought process we went through. I said the first thought process was, it was like, okay, Masterworks does this, so who are they working with to make this legal? So we scrolled to the bottom of their page and read that the securities were being issued by a broker-dealer named Dalmore Group, and I picked up the phone and acted like a big CEO from my kitchen table and said, hey, we're looking to fractionalize vacation rentals. Who do I work with and what's the dream team? And that was, I guess, the first step. But yeah, I would say, the structure is pretty simple. We identify properties that we'd like to acquire. Generally here looks at properties in destination markets. What that means are like places that you vacation at. It could be Joshua Tree, it could be the Poconos, it could be the Smoky Mountains, Rocky Mountains, the Great Lakes, et cetera, Florida beaches, et cetera. And that's on the top level. First, we're looking at those types of markets. Once we identify properties in those markets that we'd like to acquire, we then put them on a contract. We do some diligence on the properties. We make sure that it passes our underwriting. Those are things like checking boxes on, what does the booking revenue look like? What does the average daily rate for the property look like? What does the occupancy rate look like? What does the growth look like also for those metrics as individual metrics on the property level and on the market level? And then general real estate stuff, like making sure the inspection comes back okay.
Mm-hmm. And
go ahead.
These are existing properties where there's already an Airbnb running and somebody want to sell that business? Or is there also a case where people have an idea and they want to build something brand new and there's a loan taken out there? Currently,
we identify vacation homes. And we turn them into vacation rentals. So the idea is like a vacation home that's a second home in, Big Bear, California, as an example. The idea is then we're turning it into a vacation rental. It takes very little work once it's actually a vacation home because we're buying a furnished property. But there's things you're going to do. You're going to make sure there's extra linens, towels, coffee, soaps, et cetera. But that's how we look at, the property themselves. We do have on the horizon the idea of acquiring existing vacation rentals. It's a bit more challenging from an underwriting standpoint. We have to get audited financials, so that becomes somewhat arduous. If somebody that lists their home for sale doesn't exactly sign up for, hey, we need your bank statements for the last year and your driver's license. It's kind of hard to convince a seller on the open market for that. So it's much easier to acquire a vacation home and turning it into a vacation rental because it streamlines the process significantly, and we're able to move pretty quickly still with that acquisition strategy.
And most people that have second homes that are vacation homes, is it typically just sitting there vacant for the most part? And they're just trying to, they don't have the energy or desire or means to put it into Airbnb, and they're saying, why not do this?
Yeah, I would say, it sits vacant 6 to 9 months out of the year. So, 60 to 80% of the time the property sits vacant. People sell for all types of reasons. financial reasons, wanting to, buy another home, or, needing to get cash out of an existing property. I would say the majority of them, it's like, it's just like if you ever bought a house and sold a house, you enter at one price and sometimes you leave at another, or you get sick of the house, you get sick of the location. But it really varies pretty significantly. But with second homes, it's pretty rare if they list it on Airbnb when they're not at the property. Generally, they have private items in the property, so it's tough. You get pictures of your kids, things like that.
Yeah.
It's tough to list it, for the 6 months out of the year you're not there. And most of these just sit vacant.
Got it. Okay, so then your I imagine somehow ads or SEO or something, people are finding out about here. They have a second home. They come in. You go through this auditing process or underwriting process. Do you give them a quote at like, here would be or is the first thing you do is put it up into the open market and say, hey, this is the investment opportunity, guys, come and put it in and throw up the figures and the deal? Like, how does it tactically work?
Yeah. So the sellers don't know who we are when we buy the property. Main reason why is there's a good chance we start to get taken advantage of is like here with the big money bags coming in to buy properties. So we generally buy the properties on the open market, represented by an agent in the local market. So to the sellers, we're just a buyer. They don't know that here is buying the property. So we look for properties on the open market. We do receive some off-market deals in our deal sources, but mostly they're properties that are currently listed for sale, and then we have an agent that represents us and our investors to acquire the property.
Gotcha. And then you buy it, and then is there a team locally? So you launch geographically where people are managing the property effectively as Airbnb or short-term rental managers?
Yeah, it's a great question. So we partner with local third-party operators, generally best and the brightest in each market that we select. If Big Bear is a market, we're working with, the best and the brightest in Big Bear for, property inspectors, landscapers, property managers, cleaners, you name it, electricians, et cetera. So we build an individual network around us of existing operators in that market.
I always thought there's a whole business in and of itself in aggregating that network of local, short-term rental property managers. Like if in a way, like
Home Light for property managers.
Yeah, there's Thumbtack.
It's fragmented.
It's pretty fragmented. So is a key part of it to find a manager in that area where they're just they'll figure it out. They'll find the maid to come clean, the person to come fix pipes and things, or are you guys finding every contractor that comes in?
Yeah, so we act as the asset manager. So our job is to identify and manage the manager. So, our job is to, find the local contacts, work with them, manage them. If one isn't working, we swap them out or work with a different partner on the local level. But we aren't actually setting up boots on the ground operations in each of these markets. We think it allows us to move very quickly. One of the things we learned pretty early on is the benefit of being able to launch a lot of properties in a lot of different markets. The challenge is if you go down, from 30,000 feet down to 5 feet, it becomes very challenging to scale quickly into new markets because you've got to set up an office, you've got to hire locally. So we found the best route was actually to go down a direct partnership route. So that you have local stakeholders, they've been living there for years, you're not displacing jobs, you're enriching the local economy. And generally these are the people that understand these properties and these areas better than anybody, or the people that already work there versus trying to come in and install new management and install, new service providers. So that's been our strategy. And that's what we're planning on doing for the next, several markets.
Yeah. Where is it now in terms of progress? However you measure that, either in revenue or number of houses traded?
Yeah. Great question. So we launched officially a little over a week ago, which has been great. We got SEC approval 2 weeks ago, and it took us a year to get. We had to have basically the way that they see it, or I should say the SEC sees it, it's like an IPO, and you have to take a property public. Is the idea. So we brought our first property public. It's in Largo, Florida, which is very close to Clearwater. And then once we get that initial that's basically initial public offering approved, we're then able to launch new properties as amendments to our initial offering. So we're able to move much faster. A new property takes a couple of days to bring online. So our first offering went live. It filled pretty quickly in about a week. Excuse me. And
what was the
over
value?
the next? It was about $400,000, a little less than $400,000. And over the next 8 to 10 weeks, we're launching a new property in a new market. Every week or every other week. So we've got a few properties coming online. I'm sure by the time this podcast comes out, we've got a property in Big Bear and Joshua Tree, in Gatlinburg, which is the big Smoky Mountain destination, as well as other markets, the Poconos, et cetera. So, over the next 20 weeks, we're planning on launching 20 different properties in 20 different markets, which is a big, ambitious goal. But I think we're poised to accomplish it.
It's awesome. It's awesome. Yeah, to me, it seems like we as an individual people who are purchasing homes in the U.S. place an enormous amount of our savings and our future potential savings through a mortgage and loans on one property. And it seems like to me that if you could, I would never put all of my investment in the stock market in one company. And I think that typically is discouraged against, like, from a serious quantitative traders. And it's like, well, does it make sense to allow other people to buy in, right? Because I don't really, if you buy a house, you buy a house to live in it. You don't really buy a house as an investment vehicle. Like, I want a place to sleep and live, and if the house goes up in value or down in value, you're riding that wave pretty hard. Wave. And you're not actually,
alone too.
Yeah, it's not an investment decision like I'm selling this house today to make money because I view it as a good time to sell. It's like, no, I have a job in another city, or I got a divorce, or I'm retiring, or whatever the reason is. And so people are, I feel like, very much just carried along in the wind without, and it leaves open the gap of where people can intelligently invest in real estate markets. And I wonder 100%. If you think about, like, beyond real estate, picture roll the clock a few years in the future, can people almost take reverse mortgages out in their home and say, I own a $500,000 home, I have a $400,000 mortgage, can I take half of that, put it up on the open market, I get cash in the bank, people get to own the house because they view, I live in Portland, like Portland is a place that they view the real estate market to grow. Or flip side, could you sell it? Could you sell part of the house, or buy other houses, and instead of owning like 400,000 in one house, I'm owning like 50 houses in a smaller percentage. Right. Do you think we're going that direction?
I think we're heading into a democratization of equity. So I think we're in a fractionalization of equity. I think, you have debt equity. I don't know if you own your house currently, but you have equity that sits there. Now you can do things like take out home equity line of credits and all these like funky things that you own mortgages on, reverse mortgages. Our grandparents got fooled by those. But I think the future is more or less like, I've got $100,000 in equity that's sitting dead. And there's going to be a marketplace or multiple marketplaces that exist for things that have value, meaning equity, that currently sits dead, that can be traded based on the inherent value. So I think it's going to happen across multiple asset classes. I think it's going to happen, in collectible cars. I think you could see another thing with that, housing, not just single family homes, but also commercial and farmland, industrial, vacation rentals, et cetera. I think there's a pretty wide berth of opportunity there. I think if you're familiar with Pipe, Pipe.com, they're doing that with like reoccurring revenue for businesses. And I think we're heading quickly to a world where like residential real estate's gonna have some, like a Pipe for residential real estate or a Pipe for commercial real estate. I think we're headed for that. I think really what we're talking about, like liquidity engines in a way. I think it's going to be fragmented. I think the economy's too big to have like a winner take all for each of these, for like all of these asset classes. But we largely see here in the future as a power for that in vacation rental, equity or providing liquidity there. The interesting thing about the Reg A is you could technically sell, we're not building this today, but it's an interesting idea, is that like, let's say you owned 100% of your, cabin in the Smoky Mountains, and you wanted to sell 95% of your equity and retain 5% ownership because you've got some, family or some family tied to the property. You could exit you'd be able to exit the property to 95% of other investors that are investing anywhere from, $100 up to, thousands of dollars, and still maintain ownership stake. But release some of the obligation of the ride that we talked about, where it's like you've got the responsibility of managing the property. You also with 100% of the equity comes 100% of the upside or downside. So you brought up an interesting point on we get investors all the time. I get emails all the time of why don't I just do this myself? Why don't I just buy one of these myself? I've got $100,000 I could put down. I can get a mortgage. I can do it. And it's an interesting question. It's an interesting idea because you could probably earn more money if you did it yourself because you're not using a manager. Here's not getting a cut. You're doing it yourself. Absolutely. But the challenge is very similar to what you're talking about is you have 100% of the mortgage, 100% of the duties, responsibility, et cetera. And you've got $100,000 if you're cash into that property, into that one property at that one address in that one location. What's interesting is if you took that $100,000 and you spread it across 1,000 properties of $100 investments, you're incredible, just like what you're talking about with stocks, incredibly diversified. You have no physical risk of having to manage the property. And you get exposed to markets that you wouldn't have been able to be exposed to before. And I think you could apply that same template to a lot of other asset classes. I don't think here is unique to that. I think that's something, it's a trend that's going to continue of I could put all my stuff in this, but why would I do fractional? And I think the real reason is fractional allows, extreme diversification and without giving up the ownership stake and ownership rights that you get with direct ownership.
Yeah, I totally agree. I mean, it seems like common sense when you say it. It's like the idea of just, you're almost arguing for putting all your eggs in one basket versus diversification. And I just suppose previously there just wasn't the mechanics or you called it the liquidity mechanisms available, right? How could I put $1,000 into any kind of property in, Lake Tahoe if I wanted to? Where do you go? How do you do it? It's impossible.
It's tough.
Where are we now? If someone's interested in investing $100,000 into real estate, here is, you guys have one property. Are you guys at the bleeding edge? Are there other segments of real estate that are open today for fractional ownership?
Yeah, I mean, there's a couple of platforms that exist today. I think, Fractional comes to mind. I think it's Fractional app. It's the platform. And they allow you to own a quarter of, a quarter of a property, 25% ownership stake or, 50%. So it allows a group of friends to come together to invest. So we think that's really exciting. I'm actually really excited about that product. A friend of mine runs a company called Doorvest, which is similar towards Fractional, with a bit more where you own 100% of it, but they handle the logistics, they handle property management, making sure that it's filled with a tenant, things of that nature. There's a great company called Acre Trader, which is kind of here for farmland. So we're really seeing it explode. I'm friends with a couple other founders. I mean, this is how it goes when you start these companies, you become friends with all the other founders doing the same kind of weird bleeding edge stuff. I have a friend of mine, Nick, that does fractional ownership of wine, rare wine that's worth a bunch of money. So it's this really cool, this rare Screaming Eagle, vintage worth $5,000 a bottle. And in 3 years, it's going to be worth $10,000 a bottle. And they can map out. It's I put $100 into this collection. It's actually it's uncorrelated to the stock market. It's been going up historically. So it makes a lot of sense. So I really think fractional is the future across all asset classes. And I've got a million examples of other platforms that do the same type of approach to a very hard, arduous platform or asset class. Fine wine is a great example. It's where do you buy rare wine? I don't even know where to go. I don't know where to look. I don't know where to tell if it's worth any money or if it's fake or real. Same goes for artwork. How do I know if it's real? How do I store it? I mean, if I bought $1 million piece of artwork, I can't store it in my living room at my house. I've got to store it either somewhere that's got a bunch of security or somewhere with insurance for if there's a flood. So these really high barrier to entry asset classes, I think, are probably going to be the first to fall of fractionalization really powering these industries.
Yeah, I think there's the trap there that you're kind of surrounding, or almost like a blind spot that I think is important we don't walk into, which is that we invest, and this is where I think NFTs largely are today in many ways, which is that I'm investing in, we'll just call it an asset. It could be digital or physical, that's not delivering any value to any human being today or for the foreseeable future. And this is the difference between, a piece of art hanging in my living room versus a piece of art locked in a basement somewhere, stored purely for the growth and value of it. And I think the same thing with the wine bottle. I can see like there's wine. You can own a wine bottle, and that wine bottle exists. And the reason why it's valuable is because we own it, and we say one day we're going to sell it to somebody who's going to pay a lot of money for it, and they're going to drink it, and they're going to cherish that experience. But it's the human experience. It's that like emotional experience of, wow, this is a great wine that I'm drinking. And if you don't imagine selling a beautiful, like a $50,000 wine bottle, but there's no wine inside. We're trading this bottle. It's worth $50,000 and $60,000.
Good point.
And then at the end of the day, it's like this is the same. We're circling back. It's like
it's a good point. Actually,
this is the negative reputation that pyramid schemes or Ponzi schemes generate. You're selling something that just keeps on needing to be sold and doesn't have any value that is ultimately delivered. Unlike houses, real estate, where I'm living in a house, I'm getting value from the house today.
Sure.
Therefore,
there's a scale to measure it on like a monthly basis. It's like, is it performing? There's something going on. There's cash coming in and out of the property. There's transactional value. Makes a lot of sense.
Yeah, otherwise, we miscalibrate what future value looks like. Like if I buy a JPEG on an NFT, I'm assuming that somebody's going to highly value. They're going to look at that thing and they're going to say, "Oh, that's great JPEG." I'm getting, art is like this, right? Because art can really change you. You can look at a piece of art and say, "Damn, that it just carries with it some deep ideas and it changes me, the person."
Inspiration.
Right.
100%. Yeah, I'm a proud owner of a fraction of a Bored Ape. So like I use Rally Road, which is, a platform that's fractional ownership of different collectibles, things like that. But they just started doing NFTs. And I've been very hesitant to enter NFTs, but I love the Bored Apes because I think it's such a cool concept. It feels like an evolution of streetwear, feels very supreme, that type of streetwear brand, Obey, Hundreds, etc. And I watched, those prices tumble over the last, couple months. And I'm like, man, what am I investing in? I'm like, I want it to work, but it feels kind of weird. I don't know. I'm largely confused. And I think I should just stick to building my company because I get hung up in like researching NFTs. And I'm like, what am I doing here? I just talk myself into circles mentally.
Yeah. Well, I think so we have identified where the trap is. There's no end value in human experience. The road there is people place their investment intelligence or their assessment of value on somebody else. So like it's going up because other people are buying and they're really smart people or they're relying on other smart people. So I
think once you involve celebrities, it starts to get really hairy because then it's like, but they have trust and, I think celebrity show must be barred from like crypto and NFTs because that's how like grandma gets ripped off because it's like, but George Clooney, his NFT he says it's a good one. So I'm going to invest my life savings into it.
Yeah. That's actually a good sign. Tough. As soon as you see, I think of like value generation or at least price increase as concentric circles. There's people who discover it, they invent the thing, then they tell their friends, and those people contribute, they build it, they go so on and so forth. And then celebrities are like usually the last ring on anything technological. Agreed. So the day Paris Hilton tweeted out in 2017, like buy Bitcoin, it's great. There was no one left to tell. That was it. There was no one left outside the walls to buy. And so the price crumbled after that point. But you could probably draw some quantitative bot that tracks that.
Build a bot on that just tracks celebrity sentiment. And like once it reaches a certain like B or C class celebrity, it's like it's time to rip the cord out.
Exactly.
And sell.
Yeah.
That's so funny. It's a good analogy, actually.
Yeah. But man, it does feel like the fractional ownership, it unlocks real value as opposed to things that allow you to trade something that doesn't have inherent real value. I mean, property to me just feels like one of, if not the most real thing and valuable thing that a person can own. I mean, it's got to be by far the biggest thing that people purchase in their life, right? Cars really don't come that close.
Yeah, and it's becoming more unattainable. Every day that we live, our house becomes more expensive, and the house next door becomes more expensive. And the reality is that every day it becomes harder. The entry point to become a real estate investor becomes harder and harder and harder. So we think fractional is an answer. It's like this is an answer to at least lower the bar to a bar that's raising every day. And our salaries aren't raising at the same rate as housing. Our savings, whatever the savings rate is or whatever our investments are, it becomes this really hard, not trap, but it's a race that it's really hard to win to start to become a real estate investor. And again, back to that $100,000 thing. It's like, yeah, if you want to invest in vacation rentals, you want to buy a property that you don't live in, $50,000 to $100,000 down if you can get a loan. But that's just to start the race. And how long does it take the average person to save $50,000 or $100,000? I mean, you're talking years to maybe even a decade to then buy one property. And it's like, well, what if they could start the race with $100? What if they could start it with $500? What if they could tiptoe in? I think that's an important mission. We have this big mission statement at the company. And when you start out your mission statement, you don't really know, and it changes over time. But I feel confident about it. It's like very simple. We're on a mission to make vacation rental investing easy for everyone. And really what we mean by easy for everyone, meaning attainable for everyone. Because the reality is that, take vacation rentals out of it, just becoming an investor in real estate in general, it was a dream when our parents were alive. And now it's becoming a dream that I don't know if I've got a 5-year-old daughter. I don't know if she's going to be able to afford real estate. We're highly heading into this renter nation, very similar to European in a way, a lot of renters, people renting at the highest rate they've ever had, in American history. I think we're going to continue down that path. So it's tough because it's almost like fractionalization is an answer to this bar, almost like the goalposts are getting moved further and further back, but we're not running fast enough to catch up with it. So it does almost feel like fractionalization is an answer to that. Even if it's a temporary one, I think it's a noble mission.
Do you see the trends happening in housing, at least domestically in the U.S.? The rates of new construction are just not keeping up nearly at the pace that they should be because of local zoning laws or state regulations or something? Or is there a boom in the number of people trying to purchase housing because of COVID, where everyone moved out of cities? I'm sure it's some combination of these. But trying to just understand the macro dynamics that are going on.
I think it's the cost to build is the secret thing that's haunting everybody in the industry of creating housing. Because if affordable housing was easy, we would just build it. And I think the reality is that every city gets behind affordable housing. You live in Portland, I'm sure they're behind affordable housing. Miami's behind affordable housing. New York's behind affordable housing. But the cost to build is so expensive. So as the cost to build continues to increase, again, back to the point of unattainability, it's it becomes harder and harder to create housing affordably. And it even goes for rentals. I still live in the house that I moved to. Full transparency, I live in my grandma's house that I moved to when I lost my company and my wife and everything, lost everything. I'm still here because I started looking at rentals a couple months ago. So I'm starting to move along. Everything's fine. We're kind of moving out of COVID. I start to feel confident again. And it's crazy because the rentals I was looking at have gone up almost 40% on a monthly basis. And Florida's one of the highest, increasing rental markets here in the United States over the last year or two. And I don't know when that's going to end. So it doesn't just apply to home ownership for affordable housing to buy, affordable housing to live in, but also to rent. Rentals are also becoming super expensive. So until we find a way to build houses, I guess more cheaply, is 3D, printing the future? Is, modular housing the future? I'm not sure, but it does feel like that's not slowing down either, which is that homes are becoming just more and more expensive to build. Labor's more and more expensive to build. The materials are more and more expensive to build. And you've got the land that also is increasing in value. So it's a really tough problem. Yeah,
it certainly does seem like if we're saying the cost to build is increasingly expensive, then it's either the labor costs or the materials costs that's going to chew up a majority of that. And the labor costs you can cut down by building modular homes. And in theory, the material costs you could also cut down by building modular homes, probably less so than labor. I'd imagine you could, in theory, like have a machine that just builds houses and then ships them out. And there's a company I saw that was working on this where they had, their whole thing was these panels. It was like paneling housing, like almost like connects pieces or Legos, where the panels were so modular that you could configure them.
Like Blockable's one I've heard of.
It might have been that company.
Yeah, Ionic is another one that actually prints on site, which is kind of crazy. It looks like it's like layered in like caterpillars. Like it's really interesting. It's called Ionic. I don't know how to spell it exactly, but I hope that's the answer. But until then, I don't know if the race slows down. Like I don't know if this like race to crazy. But I mean, if you look at Europe, it's very similar. It's like, to become a homeowner, it's a lifelong mission. It takes in America, it feels like an earned right. And I think we're kind of slowly becoming European in regards to how housing is treated, where it's just incredibly unattainable from an ownership standpoint. Yeah.
It may be some function of the increasing wealth gap, right? The people who are owning the houses might own multiple houses, and the people who don't are renting out at increasingly large numbers.
Certainly. Yeah. That drives rent too. Yeah. Think about that. It's like, if I can't find a house to buy, I then have to rent when I would have been a buyer. So you've got rental inventory shrinking, which then drives up, supply demand, pretty easy economics, which inherently drives that cost up. So I think that's a part. And then if they want to build new inventory, the cost to build rental, an apartment building is, no cheaper than it was, a day or two ago or a month ago. It continues to go up in value or continues to go up in cost. So it's a really complex problem. Nobody's been able to figure it out. Nobody. I think this is going to be the problem of the decade, frankly.
Do you think people are understanding it increasingly so? Like we're making progress in the confidence of our understanding of what's going on? Because it seems like the homelessness problem is getting worse, and that is probably much more complicated than people give it credit for, encompassing things like the mental state of people. It could even be our diets, the nutrition and the food we eat, all the way to our health of our bodies and our minds, our ability to be productive in the world, the relationship that the U.S. has in productivity versus other countries. Like the idea of people not being allowed into the country via legal just immigration because they're taking jobs, means that you are saying, when people have that stance, they're effectively saying that all the purchasing power is in the U.S. And I think that is completely ignoring the reality that we're living in a society where trade is happening across borders. So you have to buy and sell across borders if you want to have either a big business, and big businesses want to have productive workers. So it's not, you're not competing locally anymore. And I think people who think local end up drowning. They drown in the lack 100%. Of opportunity that's there. There are other factors. That you think of?
I mean, it's like, if they can't build affordable housing, can they at least build affordable hospitals that then, provide mental health services to homeless people to at least reduce the number of homeless people, or find a trend line of like these specific, diagnoses, there's got to be some science on this or data or something that says like these certain circumstances from a mental health standpoint drive somebody to homelessness, identifying them as soon as possible, and then finding a way to treat those types of people as quickly as possible to at least reduce the number of If we can't solve the housing problem, maybe we can at least solve the mental health problem, because I think that's not an easier problem to solve, but on an economic standpoint, I think it's easier to solve. I think it's a cheaper problem to solve, frankly, just based on the cost to build housing. So I think like on homelessness, I think that's the obvious, solution. If everybody is just like, well, it's just too expensive to build, so like we're not going to solve this. But it's like, but you can cut this a million other ways to at least reduce the number of people that are homeless, which then helps affordable housing, et cetera. It's such a hard problem.
You want ultimately, I have said this before, but we really do want the most number of people to be the most productive they possibly can for our own self-interested
Yes.
benefit, right? Like no one is ever, you hear signs, people have signs they make and they could say, I'm against poverty. It's like, who is ever for poverty? No one is for homelessness, right? So,
Nobody, only psychopaths are for poverty, basically. You know what I mean? Like
it's really,
nobody's against poverty.
It's not a serious stance.
Nobody's for poverty, I should say, not against poverty.
And so, then it's like, well, what's the underlying like collective trend that's going on? And really, I see it as, in large part, the ability to add value to society. Like productivity is a word we use, but it's if you're adding value to society, you're getting rewarded for that. And through that reward is payment, and you can buy things and integrate yourself and have a place to live, at least rent, and so on and so forth. And if you get disengaged with that value creation mechanism, for almost a cold way of saying it, whether you commit a crime, go to jail, have a difficult time getting integrated back into society, you lose your job and you're out of the productivity gap. Like it's a really scary feeling. And
100%.
Yeah, and I think this is the time when there's a great book I'm reading, Ray Dalio's book on the way the world is changing, and it's
I have it on my list. Actually, you know what's funny? Hold on, I want to share something really quick. This is if you're watching this or if you're listening to this, I'm picking up the book. I actually have it on my desk, so it's pretty funny. I have it on my desk right now. Yeah, it's like one of 2 or 3 books that are next on my list. How is it?
I think it's strikingly representative of what is happening today. When you read it, you think this is not a proclamation or a thing that that might happen. It's an observation of the patterns that are happening. And so there's, for the first, I'm halfway through it and I'm reading it as like, oh, this is just a correct observation of the patterns. Once you see a pattern, it's like looking at a kid's coloring book. If you don't see it, it's chaos. But once you see it, it's crystal clear. And I think that kind of clarity can kick in and engage, where I think that's the kind of thing that catalyzes like social fire in a good way, like a renaissance kind of thing, a rebirth, is when you see through the chaos of the patterns and you say, oh, we can affect that. We can change it. Because the book largely predicts this rise and fall of empires, the British, the Dutch, the Roman, now the American. And it's like, I don't know. I can see it where we change that story and we reignite the fire. And
agreed. Yeah, I mean, it's not over yet. We're not dead yet, and there's still some opportunity to change. I just think it's like you almost have to take it one problem at a time. Yeah. Like if affordable housing is a problem, what small solutions can we work on like today? Like what can you do to make because I think trying to tackle the whole problem is a fool's errand. It's like there's no way you end up solving it in general. But it's like if you can find a way to make building materials cheaper or labor cheaper by automating X, Y, and Z, or building off site, or what's interesting is that housing is one of the biggest pollutants into the ground. What's funny is I forget where I saw this, and I hope I get quoted on this, but it was something like 120% of a house is built. Meaning that it was like 20 or 30% of a house actually gets left on the site, extra. So it's like bolts, this, plaster, etc. So it's an incredible pollutant. And what's interesting, and I think I heard this on a podcast of somebody that was building modular homes, is that you have tremendously less pollution when you build off-site and install on-site. So, I think just from just health of the planet and just in general, like you're not putting like nuts and bolts and extra housing junk, into the ground that isn't being used anyways. So I do think the future is largely modular. I think the faster we get off that, the better. We also build way bigger houses than any other country.
Is that right?
Like our houses are our houses are so big. I don't know if you've ever lived in like Pennsylvania or Texas, but it's like we have like 4,000 square foot homes. And it'd be interesting to see like what the cost for housing is if we're building 1,200 or 1,100 square foot homes.
Yeah.
What that looks like. So I think we have like a lot of reality checks around like cost of housing that are coming, because the majority of us are being forced to rent because we can't buy. So it becomes challenging. And then what happens with those builders that are building inventory for, who buys them? If the cost to build a house is $400,000 and they've got to sell it for $600,000 or $650,000, and there isn't a market for that, it becomes a really interesting problem.
Do you see the kind of growth in this, like liquidity mechanism that I think of what you're building as like a liquidity mechanism. You're allowing money to flow to areas where it couldn't have flowed previously. I could see things that say people wanted to build a house and they are like crowdfunding the cost of development of the house. They're saying it's going to cost me $300,000 to build this house. If you give me almost like a Kickstarter for houses, but you're owning the house and you get a percentage of the money back over time, or you get a premium on the sale price if they agree to sell it at some point in time. I wonder if the complexity of the investment mechanisms for real estate could grow, where things are possible that you wouldn't, people are swimming in very straight lines today. Like you're buying individual properties or there's business properties. Could that grow?
Well, okay, so to be careful about how I'd say so talk about this, but I'm friendly with a founder that's building a company in stealth right now, and they basically are doing something similar where you've got 3 or 4 roommates, and then 3 or 4 roommates are then almost like not fractional ownership, kind of like fractional ownership, where like roommate X owns 25%, roommate Y owns 25%, roommate Z, you know what I mean, so on and so forth. So that home ownership then becomes possible for roommates. So instead of you and 3 roommates renting an apartment or renting a house, you then own that property with those roommates. They make it possible. And again, back to the point of like it reduces that barrier. So I think I think the future is largely that, which is like taking the pressure off of one individual having to come up with 100% of the money and doing, 100% of the legwork on getting the loan and being accountable for those different things, to where to be able to sustain this, upward trajectory on home value growth and you name it, rental growth. It seems like fractional is the only answer. And, I think largely it's going to come in many different shapes and sizes. I think like the roommate idea is a really interesting one. I think like what you're talking about with like, almost like a Kickstarter type of campaign, for raising the equity to get a down payment for this 123 Apple Street that me and my family want to move into, or a platform that exists for selling that equity that then investors are then able to recapture in 5 years. That becomes a bit of a trap, though. I think talking about traps, I think there is a challenge there, because like what happens in 5 years if you don't want to sell it?
Right. What
happens with those investors? You move in with the house, you've got your family, you've got the white picket fence, so to speak. You don't want to live. You're happy with. You don't want to meet. Or you don't want to leave the place. You're happy with the school system. You're happy with your kid's room and the neighborhood, your neighbors. What happens with all the investor capital? It becomes a really interesting problem. So I think it's again another tough problem to solve.
Yeah, it's interesting. Yeah, I could see it solving. Yeah. You could, I don't know, maybe pay it off. Maybe the owner starts to pay a premium on that, or it leaks out of the down payment equity line that's sitting there.
Sure. Could transition to like a type of a loan instrument or something like that that's added on to the mortgage. Could be something like that that's paid like some type of preferred return or something like that.
Yeah. It does seem like there's incredible creativity with constraints like this. You can draw constraints around the problem and say, well, we're not going to kick anyone out of the house that they live in. Does that mean if you have can you have an agreement that says you get 5 years to live in the house? Like with a rental property, you rent the property for a year or a week or a weekend, and you have to leave. Like if you stay in an Airbnb, longer than they're there, they're going to come knocking, and then eventually
cops are going to show up.
Cops are going to show up. Right.
If you've been there for a weekend and you decide not to leave.
I think it gets more sticky morally probably when we kick people out of houses if they don't have other options
that they move into.
Right. I think there's not.
Or they moved into. Yeah.
Or they're moved into. Right. The friction's not there with rental
they
properties.
Got the things there.
Right.
Yeah. With a vacation rental, it's like you just decide, like, we threw a party over the weekend. We decided we're not leaving. And, it becomes very different. I'd say it's a very different type of door knock.
Yeah, an easier one.
Somebody that's hard up on times, and there's a different type of process.
Yeah, it's like, hey, the club's closed. It's 2 a.m., guys. You got to go home.
To be clear, here does not allow any. We have a very specific no house rules on any property, or house rules on no house parties. So like no house parties on any.
Why is that? Is that the destruction of all property?
Well, first of all, Airbnb's basically made it pretty clear, no parties.
Really?
They made it, if you get identified as somebody that throws parties, you get banned off the platform.
Ooch.
For us, it's, destruction of property.
Yeah.
There's things you can do to accommodate people, like accommodating people that have dogs and things like that. But just what's the benefit of hosting a property that's having parties? I mean, it's only destruction.
Yeah.
That's the benefit. It's only, the chance of no destruction, but the chance of destruction is pretty high.
Yeah, that's true. Yeah, I guess you just need a separate platform for that. You come and rage your face off at some no pictures on the wall and.
Yeah, you're looking for a co-founder. Let's spin it up.
That sounds like an awful business.
Party version of Airbnb. I mean,
that sounds like it's got trouble.
There's a platform that does that for movie sets. So like if you have I forget the name of it, but it's like if I want to rent out my house because it's a beautiful Victorian home, you could rent it out for like commercials and movie sets and things like that. And that's actually a pretty good idea, frankly, if you've got a beautifully designed home and they pay really well. I can't think of the name of it.
Yeah. EventUp was one. Actually, I know the guy who started that a while ago. I think the liquidity is the problem. There's just not a lot of those, and they're kind of
one a month.
They don't want to pay a transaction fee of 10% on this deal. Like they're way more likely to just do it privately. But once you get these higher value ticket items, even Airbnb, I'm sure they see disintermediation or backdooring happening over. There's got to be some trigger event.
Certainly.
3 months, 4 months.
Even us, we get messages that ask for people to transact off platform. So we'll get people that message and say, hey, I'd love to book for 3 weeks, but can we do this transaction over Venmo or over text message? The challenge is it opens yourself up to too much liability, even if the opportunity is to save $150 in fees. So it is a challenge, but I agree. As you go up market, there's definitely that like leakage of those higher value properties being listed off platform or transacted off platform.
Well, Corey, I'd love to have you back on maybe a year or so when you guys have made some farther inroads and see how things are going. It's a fascinating market. I love the fact that the legal change opens up opportunities for innovation that weren't previously there. So there's this kind of like the dam is broken and now off to the races. We can build things. It's really those are some of the most exciting business conditions to be in.
Yeah, it'd be great to circle up with you in like a year and be able to share some interesting data and some of the questions I wasn't able to ask today. Be able to share what that looks like. Yeah,
and mention the site here.co. Great domain name. Did you have that for a while or buy that?
No, we grabbed it. Yeah, we went after it. Very fortunate it was for sale, so we were able to sneak in there and snag it. But nice. I appreciate it. I'm a big domain. I feel like I've become a domain name expert. We acquired our last domain as well from like a third party for my last company, and it was an interesting negotiation.
Do you do any sort of atypical, like, are you contacting people directly at their home or doing anything?
No, we work with an incredible domain broker. Shout out Slade. Slade, he's the best name. He is the best name. It's his real name for a guy that acquires domains through like back channel.
Oh wow!
No, we work with this guy Slade. He's tremendous.
That's awesome. Any other things you want to throw out there? Are you tweeting or writing or anything that the company is currently looking for, or you personally?
Yeah, I mean, if you haven't thought about investing in vacation rentals, do Google search, look at the economics of investing, whether it's on here or whether it's, individually you doing it yourself. It's probably one of the best asset classes in real estate, largely, uncorrelated by macro real estate trends. I feel pretty passionately about that. So anybody that I hear that's investing in vacation rentals, it's a super exciting time to be in the space, and it's still pretty small. So it's not like it's over, so to speak, or you're late. There's still a bunch of time to get involved in the industry. So I guess that's the big ask. Not going to be the corny, like, hey, go to here and invest today or anything like that. But yeah, just check out, investing in vacation rentals as an idea. Yeah, thank you so much for having me today. It's been a great pleasure. I really enjoyed myself.
Yeah, it was a lot of fun, man. Best of luck with everything. Keep crushing it.
Thanks again, Mike.